What's up, guys? Welcome back to DCA. So in yesterday's video, we talked about the fact that Bitcoin and the general cryptocurrency asset class have been showing weakness in the recent weeks. Bitcoin has fallen below its 20-week moving average and then gone down to its 50-week moving average. It fell below its 50, and we showed many times on this channel how once it falls below the 50, that has typically been a sign that it will head down to the 200-week moving average. It doesn't mean this has to happen, but it is something that we need to watch for. And in the past, it has been a strong indicator of an impending bear market. We made the point yesterday that if you have just entered the market in 2021, even if it was on January 1st, 2021, you have significantly limited earning potentials in relation to individuals that have been dollar cost averaging and using a set strategy throughout the length of the bear market. So tonight we're going to take a deeper dive into this, and we're going to apply numbers to it. And I think you're going to be shocked at just how massive the difference in earnings an individual who has been dollar cost averaging throughout the bear market and an individual who has waited until 2021 to come into the market. So the point we made yesterday was, and a lot of people don't like to hear things like this, but if you're new to the market, you should essentially be hoping that a bear market starts, because that's going to give you an opportunity right now to start a journey that sets you on a path towards attaining true wealth over time. So we mentioned a quote yesterday that Jeff Bezos is talking to Warren Buffett and says to him, your investment strategy looks so simple. Why doesn't everyone just copy it? And that's because Warren Buffett says no one wants to get rich slowly. All right. And let's put that in perspective. Warren Buffett is talking about, stock market, real estate, etc. That's not what we're talking about here. We're talking about crypto, and the rate of return in crypto comes at hyperspeed in relation to what Warren Buffett is talking about. He's talking about forming wealth over a lifetime. When you're investing in crypto, if you can simply have the patience of waiting several years, you can attain that type of wealth. So keep that in perspective, guys. And tonight, what I said, we're going to apply numbers to this information, and you're going to see just how strong dollar cost averaging throughout a bear market versus a new entrant into the market, just how massive the difference truly is. So if you guys like this type of content, remember to hit like and subscribe. We're a new channel, so everything helps. And what we're going to do tonight, and while we do this analysis, we're going to use two different sets of dollar cost averagers. One individual is going to simply dollar cost average once a week, no matter what, always. They're going to every Friday or whatever day, they're going to dollar cost average a set amount, okay? And they're going to do it starting right at this point. And they're just going to dollar cost average all through 2018, all through 2019, all through 2020. And then they're going to continue dollar cost averaging in 2021. Then we're going to use a second individual who uses a dynamic dollar cost averaging strategy using the DCA index risk model. Now, using a dynamic dollar cost averaging strategy using this model is simply one method by which to pursue this strategy. It's by no means the only method. It essentially just takes a look at where the market is and attempts to identify where the lowest points of the market are likely to be. And by doing that, it helps you to dollar cost average more into those points in the market and less into these higher points in the market. So the rule that we will use for this, if the DCA index risk model is above 50, we will not dollar cost average. If it's below 50, then we will do 1x from 40 to 50. Then we'll dollar cost average 1.5x from 30 to 40, 2x from 20 to 30, 2.5x from 10 up to 20, and then finally 3x if the DCA index is at the lowest tier on its risk index, which is 0 to 10. Okay, so 1x at this level all the way down to 3x. And that means in the dynamic strategy, there are certain weeks you won't be DCAing anytime that it's above 50. Whereas in the static dollar cost averaging strategy, you'll simply DCA 1x every single week. So overall, there will be times where you're dollar cost averaging more per week than you would be against the static strategy, but you'll be doing it every week with static strategy. And we'll just go over all the numbers and you can see, which of these strategies yields the best results. Okay. So with that said, if you're interested in the DCA index model, you can head over to the Discord channel and sign up for this for free there, and I'll get it sent out to you. It's a machine learning algorithm model which helps you to identify market cycle peaks and market cycle bottoms. And it basically just points out when the market is overheated for any given asset that it analyzes, and tells you, this asset is likely overheated. It's probably going to pull back. And it's been fairly successful up until this point of identifying those positions. Okay. So with that said, guys, let's do it. Okay, guys. So the first situation we're going to look at, this is an individual who comes into the market right at the beginning of 2021. And this individual is smart. They come in and they start dollar cost averaging right away. So this is very few people that participate in this market. But this guy is taking a guy or girl is taking a very smart approach and beginning with a dollar cost averaging strategy. And they're just going to simply dollar cost average once a week. And we had to just pick a number. So I picked $250 to give them approximately a nice round $1,000 per month. And what you're seeing in blue is the quantity that this individual would have invested up until this point in time. Okay, and we're talking about Ethereum. And right now they would be sitting right at around $1,300. Okay, this in red is the amount of Ethereum that they've accumulated over this time. And you can see that we're using the secondary y-axis to show the amount of Ethereum that they've accumulated and the primary y-axis to show how much they've invested. And they have accumulated approximately 5.6 Ethereum throughout this year. Not bad, right? Investing $250 every week, you have accumulated 5.6 Ethereum. So that brings us to this. What would this individual's portfolio value be right now? And remember, they haven't sold anything. They're just buying and accumulating and holding. And this person is doing pretty well. At best, they were up to $25,000. So now the red is their portfolio value. The blue is how much they've invested. And you can see the red line has been above the blue line essentially the entire year. So they've been in profit almost the entire year. And currently they're sitting right at around $19,000, $19,400 after investing only $13,250. So essentially, this person has just over a $6,000 profit. And as a percentage of all the money they've invested, they're up, right around 50%. So not bad at all. Okay, so now we're looking at the static dollar cost average investor. And remember, if we go back to the chart quickly, this is an individual who does not use a risk metric. They simply invest every single week. And they just, they continue investing every week, regardless of what the market's doing. So this individual in green, we're looking at how much this individual has invested over time. And in blue, we're looking at how many Ethereum they have accumulated since May 1st of 2018. And since May 1st, this individual has accumulated approximately 172 Ethereum simply by investing $250 every week since May 1st of 2018. And their total investment has been $48,000. Okay. So for a $48,000 investment, they have accumulated over 170 Ethereum. For reference, when Ethereum was $4,000, that same investment would get you 12 Ethereum. Okay. So just keep that in mind. When we were at $4,000, what this individual was just slowly doing, $1,000 per month, they accumulated 172 Ethereum over the course of approximately 3.5 years. So from May 1st, 2018 up until current day. So next, let's see what the difference between a dynamic and static dollar cost averager are. And remember, a dynamic dollar cost average strategy involves using a risk metric of some type or some sort of metric that you use to determine when you will invest more during what times and at what times you simply won't invest. So, like we said, below 50, you will simply invest 1x, then 1.5x, then 2x, then 2.5, and then finally 3x. All right. And when you're above this 50 level, you won't invest. So for basically the first half, or you could think of it as the majority of 2021, you would not have been investing anything where your static dollar cost averager continued to buy even through these levels. So, at 1200, 2000, 2500, etc. All right. So this is our dynamic dollar cost averager. And in the lighter blue, what we're seeing is the amount that this individual has invested over the course of the 3.5 years. So whereas the static dollar cost averager invested $48,000, this individual would have invested slightly more at approximately $54,750. So just a bit more than the individual who was simply investing every week. And that's because we're stratifying the levels at which we invest and increasing it as the market goes down into a bear market. Whereas the static dollar cost averager, just again to reiterate, is simply doing 250 every week without question. And so now we want to know, just because you invested more doesn't mean you accumulated more. However, what we see is that if you notice this dark blue line, look at the periods where the line becomes more vertical. These are the times where you are accumulating the most Ethereum. So for instance, we're looking at late 2018, and then it sort of plateaus in the middle of 2019, and then it sort of kicks off again in late 2019 and early 2020. And if we come over here, we'll see why. So we said late 2018, you're accumulating much more, and that's because the price really started to tank then, and the DCA index indicated that we were likely approaching a low. And so we increased the amount that we were dollar cost averaging. And then in 2019, the middle of 2019, we stopped acquiring Ethereum, and that's because we got above 50. And at that point, maybe we would have sold some, but remember, for this exercise, we're not doing that. And then into the beginning of 2020 and early 2020, that's when we started accumulating more. And you'll note that's when the price was down here below $200. That's when we're accumulating the most Ethereum. So basically below $200, according to the DCA index risk model, that's when we're accumulating. All right. Comparing that to the static dollar cost averager, their accumulation curve is, sort of influenced much more by the price at any given time, since no matter what, they are investing every single week. There will be times where, as a dynamic dollar cost averager, you're not investing anything and you're just sitting, you're sitting on the sideline until the price becomes favorable for you. So you can see that this individual accumulated approaching 278.6 Ethereum over this 3.5 year period. Compare that to the 175 or so that the individual who was statically dollar cost averaging was able to accumulate. And the difference in the level of investment was only $6,000. So this person was able to get approximately, very close to 100 more Ethereum simply by using a risk model to time their purchases. So let's compare what the portfolio values of an individual who statically dollar cost averaged for that 3.5 year period versus an individual who dynamically dollar cost averaged for that 3.5 year period. And what we see is the individual who was dynamically dollar cost averaging is currently at around $960,000, whereas the individual who statically dollar cost averaged is currently at around $590,000 on a total investment of about $49,000. Both of these individuals have certainly, in all likelihood, changed their life financially. So what this shows us is the individual who dynamically dollar cost averaged compared to the individual who statically dollar cost averaged. So in other words, the individual who had some sort of risk model, some sort of metric to help them guide their purchases, outperformed this individual who was just simply putting in $250 every week robotically by about $400,000. And remember, the most important part, these are on investments of $55,000 and $49,000 respectively. And, I understand not everyone can invest $1,000 a month, but it's not like you need to be a pre-existing millionaire to put $1,000 a month into a market. Now, let's say you have $500 a month. Well, the same thing applies to you, or $250 a month. If you can only afford to invest $250 a month, I doubt you're going to be scoffing at $250,000 by the end of 3.5 years. And, that just goes to show what the power of a bear market is. And it proves the statement that bull markets can make you some money. Bear markets can make you rich. All right. Now there's one last thing I want to show you, or two things left to show you. So if you're at the green line is when you're even on your investment. The red line shows you if you're up or down on your investment. If you're below the green line, you're down. If you're above, you're up. And I want to show you why it's not so simple just to throw money into the market every week or to use a dynamic dollar cost averaging strategy, and why so many people are unsuccessful at it. So during the bear market, if you're dollar cost averaging every week, I'm showing you here up until May of 2020. So basically once the bull market really started to get going. So this is the start of May 2018 all the way through May of 2020. And what you're seeing is, for a significant amount of time, in fact, for over a year, you were down on your investment. So when you're down to 8, you're at 80%. You have 80% of your money left. At 0.6, you have 60% of your money left. At 0.4, you have 40% of your money left of whatever you've invested. And there were times in this cycle where you were down approximately 65%. So if you think this is so easy, and if you're like, oh wow, this is really easy, anyone should be able to do this, it's really easy to become a millionaire. This is why it's difficult, because you have to have the intestinal fortitude to sit there and watch your investment dwindle and dwindle and dwindle, and then keep putting your hard-earned money into it, in spite of the fact that you're seeing it dwindle every single week, and having the conviction in what you're investing in to the point where you just, you worked all week, you just worked a 50-hour week, let's say 40-hour week, whatever it is. You get your paycheck, then you're going to take whatever percentage of it and in your mind throw it away, because this investment has been going down and down and down and down in the bear market. And every time you put money in, you get that paycheck and it's time to put more money in. The money you just put in the week before is now at half what it was. And then it happens again. And then it happens again. And it happens again. And it happens for a year and a half. So the people who are able to be successful are able to grind through that stage with the conviction that eventually there's going to be a payoff. And the sad reality is, you're not guaranteed anything in this life. So you are by nature taking a risk. I can't tell you, no one can tell you that this investment is going to play out in the long term. We can simply believe that it's going to, and that's why we invest in it. So, that's why another thing you often hear is don't invest something you can't afford to lose, because if, let's say, something happens, and this is true of any investment you make. If some unforeseen event happens that completely changes the fundamental value of whatever your investment is, it can completely derail everything that you've done, all the work you've done. That's something to keep in mind. And one other thing I want to note here, if you look in the middle of 2019, this would be a crushing blow. Finally, his investment starts to become profitable. And then within 6 months, it's back to being at a loss again. In fact, it goes down about 32% from there. And then again in 2020, it goes up, and then it's down again after COVID. So if you lose your nerve anywhere along this road, if you lose it here or here or here, or then it goes up and then you lose it here, or then COVID happens and you're sure it's the end of the world, everyone's getting sick from COVID, it's all over, and you lose it here, then you lose out on what ends up being this. What ends up being this, your guy who's up 25x shortly thereafter the COVID capitulation event. All right. The final thing I want to show you. So this is the chart that we've already looked at, except what I've done is added the new entrants total market value compared to the two guys that stuck it out, stuck with it all through 2018, all through 2019, all through 20, stuck with it during COVID. In fact, invested more, the dynamic guy invested more during COVID because he believed in the asset. These guys are here. The guy who just came in 2021 at the beginning of the year, in spite of, he's been investing for an entire year now, dollar cost averaging every week. His portfolio value is $19,000, whereas these guys are at 600,000 and at nearly $1 million. And this guy has invested about 25% of what these guys have invested. Okay. So it just shows, if you're a new entrant into the market, your possible upside is massively limited compared to an individual who is becoming rich during the bear market. So that's going to be it for this one, guys. If you guys like this type of content, hit like and subscribe. Don't forget to head over to the Discord channel where you can sign up for the DCA index risk model. I'll send it out to you as soon as possible. And until next time, as usual, see you.